Okay, good morning, traders. Today is Thursday, September 19th. Michael Boutros here with you for this live intraday strategy webinar to wrap up the week, guys. Good to be with you, Danielle, DJ, Pete, Pooja, Steve's in the house today. Aurelian's back in the house. Great to see the crew. So, I do want to apologize real quick for last night, guys. I had to be at my daughter's kindergarten orientation, so I couldn't really give the attention to the update as needed. But we did get some fireworks, I guess you can say, on FOMC. But what happened? At the end of the day, all the ranges still held, and we're looking for those range breaks for clarity still. So we have DXY on tap. We'll hit Euro. Liking the price action there, testing the weekly opening range highs close to nearby now. Gold did a false little bit of a dip there, but never cleared the range lows there as well. Aussie dollars with a break lower. Dollar CAD holding near the highs here at resistance. Dollar yen stalling into the highs. And obviously we'll be looking at SPX, which did hold itself up yesterday as well. Any other questions or trade setups, guys? As always, feel free to throw them in the message board. I am feeling a little under the weather, so if my voice is a little coarse, I do apologize about that. But let's jump right in. Well, first of all, I'm sure you guys saw my tweet, but the FOMC rate decision. Look, here was the difference in the dot plot from the September read, which we got yesterday, from the June read. And the main takeaways here, again, obviously the distribution on the 2019 close has really spread out. You got any expectation for a print of a 2.5 into the close of the year, that pretty much got dumped, okay, with the majority right here now. Okay, this is even laterally, I set it up this time, so it's exact same level. So a dramatic shift lower, right, in the expectations for interest rates heading to the close of the year. No surprise. The markets largely had this priced in. What wasn't priced in, or I should say what was different yesterday, is, like I said in the note, guys, it was basically a hawkish cut. And that's to say that they cut interest rates because the markets had been priced in. Don't think he could have backpedaled that one. And with the backdrop of global equity, global central banks easing across the globe, it's kind of a no-brainer that this was going to happen. But certainly curbing the appetite um, for further cuts. I mean, we'll take a look at the CME in a moment to see what the figures have changed for this morning. But um, keep in mind they explicitly said while the risks are rising, definitely we're pretty dead on with inflation. That's starting to tick higher. We're pretty dead on with employment, and that's the Fed's dual mandate. So playing both sides of the table, a lot of different interpretations as you read across Bloomberg and Reuters and CNBC. You'll get a whole bunch of different flavors in your mouth, but at the end of the day, I think price action was pretty clear. And with that in mind, we do need to note that the terminal rate, where the markets or where the Fed members, see the terminal rate or longer running rate of interest rates, hasn't changed. Distribution, again, has tightened a little bit, or I guess I should say lined up more so at 2.5, but we're still largely in the same range, right? So with that being said, what does that mean for markets right now? So here's what interest rate expectations look like now. I'm going to default the October read, which shows less than a 50% chance now that we'll get an additional cut. And I'm going to go straight to December. Because as you get into December, you start to be a little bit more above the 60% range that you're still going to see at least one more cut from the Fed. Okay, so the volatility was pretty decent, but the larger ranges held. So here's what the setups look like across the board. I'm going to try to get through this if my voice holds at a decent pace today. But here's the update from last night. So DXY. Here is what the weekly charts look like. So again, hey man, great to see you. Thank you. Yep, we need your voice, says he, man. Yeah, me too. It's not easy having a 5-year-old running around. So I'm doing my best. Here's the DXY on the weekly chart, guys. So Again, I just wanted to note it, this is the same slope that we need to look at heading into tomorrow, okay? It's pretty clear on this thing. I'm counting this as a false attempt again for another test of this basic slope, but I just want to highlight this into tomorrow. Watch where we end up. We've never cleared this slope on a closed basis, okay? And the parallel never got invalidated on a stretch basis. So it's solid. Any way you look at it, it's solid, okay? And we're still there. Divergence trigger on the weekly chart heading to the close of the week. Watch that. Watch that. If we break below the basic slope off last year's low, would be a start. Okay, would be a start. Now, if you feel like, or if you have the sense that we've been here before, it's because we have. Okay, it's because we have. Nothing's changed. Here's the DXY on the daily chart, right? Here's what it looked like ahead of the release, and we went over what the implications were. Obviously, we'll take a look back at the GDP release from this month. This is last month's, but you didn't see much of a change. A little bit of an update in the change in real GDP. They upgraded that. PCE held stable, so the inflationary outlook looks pretty good. Here was the dollar ahead of the release. Talked about monthly open resistance, high day close being bearish inbound 98.83, key support 97.87 into 97.71. Huge region of critical importance. That's still the level. If you look at this chart, you wouldn't even know that a quarterly Fed interest rate decision played out last night or yesterday rather, with updated projections and forecasts and the like. You wouldn't even know. Okay. Intraday chart looked like this. Now the onus was sort of on a break below this confluence zone. Really, the 98 handles the 618 at the near-term rally. Last week's swing lows, you had a slope confluence there. That's sort of the region I need to see give out to get this thing going. On the rebound yesterday, we failed just again at slope. Here's what it looks like, right? So nothing changes. I'll just take a step back. I don't want to tell stories and all this, guys, but yesterday in the daily FX offices, we know a lot of people that are all different types of traders, and throughout the different trading desks in the city, we talk to them throughout the course. They just got to get an idea of what their just contacts I've worked with for years and years, over a decade, and it's funny to see the fundy guys sort of spin their own tops. They're going nuts. They're, oh my goodness, the Fed is this and the Fed is this. The dollar is going to rip. Yesterday, dollar started ripping, and once you see all that excitement start to pan out, guys, especially on the fundy guys, that's kind of a fade and a half. That's like your opportunity for a clear-cut signal. So as DXY was trying to make it rip through the highs here, it failed at the momentum. It failed at the 16 momentum, and it failed at the upper parallel. Same 75% line we were looking at. Here's the turn lower. Now, for all intents and purposes, this is still holding the initial weekly opening range. Nothing's changed. A downside break below 98 would still be needed just to validate a break of the weekly opening range. Here's your weekly opening range lows. Topside breach above 98.94 into 98.83. We talked about this zone since last week. That's still a confluence zone at this point. The slope converges on this region heading into the close of the week. That's my bearish inval. This is what's needed to mark resumption of the broader decline. So right now, unfortunately, kind of from a trading standpoint, you're slap in the middle of the weekly range. If you're not already doing something here, sit back, enjoy the show. If you're holding short, stop needs to be, a conservative, a more, well, let me take this back. Initial resistance 98.43, but the stop for me, if you're anything, if this is going to put you out of the money, then go break even, but this would be the stop high that I'd put it against. You're looking for a bank or a break below that slope to get this thing going. And again, 98 is just going to be an initial downside target that comes in the 75% line, basically into the close of today. And then this is the big region. We've been watching 97.71. Those are the former swing lows from back here in 2018, or former swing highs, excuse me, from 2018. It's also the 100% of the decline off the high. So that gives you a 10 pip range of key support just below basically where the market's been gapping on every Friday decline. So keep that in mind. DXY is still ultimately a weekly opening range break. If the break happens to the upside, still got to clear this region, okay, before we get bullish. And if it breaks to the downside, you still got to clear this region before you start to validate that there's a bigger decline or a bigger drop off at hand. So, wasn't the end all interest rate decision that everyone was expecting, but certainly, Powell's, like I said, and I'm not going to go over this again. We went over this earlier in the week. He's really stuck between a rock and a hard place. I mean, satisfying the market, satisfying the administration, satisfying business. There's a whole different swath of things that he's got to incorporate here. But at the end of the day, coming out with a cut and then being excessively dovish, which is what the markets wanted, essentially, there's just no justification for it. The data just isn't there. So that's my take on the DXY. Again, pistol to my head, I still favor fading weakness or fading strength rather, while below 98.83, 98.94. Ultimately, we need to see that break below 97, 71.81 to get this thing going. So that's DXY. Here is euro dollar. Okay, and here's what we said DXY last night. We were standing right at that resistance level that held into overnight trade, guys, and we're still holding the same exact levels. No change from last night's update. Here was euro. Another one, just a quick before and after. Here's euro dollar before the Fed. The night before we were checking, and I just noted, guys, it's made a full circle. Euro is essentially unchanged heading into the FOMC. Checking weekly open resistance at 110.73. Okay, with key support still at 109.90, 109.96. 112, 111.12 is the break that you would need to validate the breakout. Favoring still that we submit that still this was a more important significant low that we placed earlier in the month. So we need to get this breach to validate that. Obviously, the daily chart hasn't changed, but here's what it looked like last night. So that pullback held. We made another attempt at the weekly opening range high. FOMC came out, slammed us lower, but we held that slope pretty decent. Okay, we held that slope pretty decent. Even on the next leg lower, things kind of held ahead of the 109.90 threshold. Okay, here's the rebound. Things look decent, guys. Again, if you're not already in this, don't start chasing here. But if we do see an objective break above the weekly opening range highs, that converges on the slope right now, precisely at 110.85, 110.86. If we get above that, it's only 20 pip spread or so before you start to jump into the next major resistance region. But this would essentially suggest objectively to look higher. Now, like I said, the 111.07, 111.12 level, that's just the 38.2, the entire decline. 111.12, 111.07, remember, came up as a couple of big interesting spots a couple of weeks ago. It is the objective May lows, but there was also, can't recall if it was a weekly open or a monthly open in there, or the low day close, I think, was in there from the previous session. In any event, that's still the level we need to get through. Okay, is that 111.07, excuse me, 111.12 as resistance to validate the breakout. Till that happens, don't get faked out on this. Okay, it's simply a weekly opening range break. Looks like there's a near-term consolidation. I thought that much about gold, which we'll look at in a moment. That kind of took that back, but look for a break of this objective range. Ideal scenario, we do see the topside breach and retest of that 111.12 or even 110.73 as former resistance, then support before the move off. If we break lower, okay, I have bullish inval at 109.72. That's the low day close, guys. If we get through that, we might catch support here, but at this point, we're kind of drawing at straws. I don't really want to test that. So for all intents and purposes, we're favoring fading weakness while above 109.96, 109.90. That's kind of my line in the sand on the immediate front. Any questions on euro? Holding long. So if you're holding longs already, I mean, 110.73 is the weekly open. The weekly opening range highs is just a little higher. I wouldn't necessarily want to. I wouldn't necessarily. If you have a decent, let me say this: if you have a decent entry from anything sub 110.20, 110.30s, I would say go break even or better. And yeah, take a quarter off here, take a third off, do something because that is a near-term inflection. Not only is the objective weekly open, but we've seen resistance here before. I just don't want to encourage or prompt you guys to bail completely. Does that make sense? Um, because if you do see the breach here, you're likely going to see an accelerated pop. So point being, you want to play defensive as far as putting your stops at break even or better. But if you have long exposure on the line, I would just be peeling off at the levels. I wouldn't necessarily be looking to dump at all. Okay, even if it's a small amount, you want something on the table here if you get the pop. Just my humble opinion. Okay. And the last thing from last night's shortened update was gold. So I put out a piece on Daily Effects about this as well. Look, this thing is, nothing's changed in the fact that our primary sort of idea, let's say, was that we needed to register a new low. And even if you remember in the beginning of this week, as we were doing the webinar, we were talking about, well, ideal scenario, we push higher, fail, and see a new low before resumption. I mean, was that it? We didn't really make a new low. We tested the low. You know what I mean? Weekly open support, even on a 2-hour close basis. Hell, even on an hourly close basis, couldn't get a move below. That was really clean at 1488. Here's the pivot back above 15, 1497, 1493 was a pivot zone that we were targeting on the way down here. So what do you do with this? Well, I think with this one's even closer, or it's even cleaner that we are in an embedded near-term consolidation. Here's a series of lower highs, a series of higher lows, dismissing that, right? Why does Siri always think I'm saying her name? But even if you dismiss that, right, and look at this from a closed basis, yeah, you're getting that consolidation, right? So look for a break here. I still think the same exact setup exists in that if you get the downside break, specifically 1488, you look for 1478, you look for 1460, and then resumption of the broader uptrend. No one's getting excessively bearish on gold. We're just debating, we're just challenging whether this decline is the whole kit and caboodle as far as the corrective move in gold prices. You had some divergence into a major slope resistance. We pivoted back above this. Remember, 1522, 1526 is even more critical now. Not only is it the late 2011 low and 2012 low, it's also this month's open and this week's, I guess that was last week at that point, the range highs from last week even. That's exactly where we tapped it, right? And pull back again. So look, it's a near-term consolidation within this downtrend. Near-term resistance still 1511. I had yesterday, I put 1520 for you guys as we were trading just shy of that. I'm going to use that as our near-term bearish inval. If we get through that, you're probably going to see a run on 1522. I want to see acceleration there. It wouldn't be anything to do necessarily from a trade standpoint to operate on, but that's the level we would need to get resumption. Okay. I'm still of the mindset that this thing could continue to range in the weekly opening range here, maybe into the apex of this consolidation. Ultimately, ideally, you get a downside break again before it starts to resume. But we'll have to see. Dollar's coming under some pressure. And again, dollar pressure inherently sometimes will put a floor under gold prices, which is priced in dollars. Again, the weekly charts for gold really leave, first of all, the weekly chart for euro too, guys, just keeping in mind why that 111.7 region is so critical, right? Basic slope resistance off the highs that we made from June also right into that region. So the weekly closes here are absolutely paramount for DXY and for euro. Here's gold, right? I just wanted to show you this and that. Like, even if this thing were to stretch intra-week, that's still critical resistance. A basic 38 of this 38.2% retracement of the stretch doesn't even come in to like 1450s. Here's what it looks like. Just again, don't take my word for anything. There's the 38.2. 236 rather, right? Doesn't even come into like 1460s, 1450s. My point being, there is room. Okay, there is room for the downside before you even run into any major weekly structural support here in gold prices. Any questions on those three updates from last night? I mean, if there's a takeaway, those are the three that I'd be very focused on into the close of the week. Really, really critical. Now, if there are no other questions, we'll jump into Aussie. So this thing went way deeper than I wanted to. That's one, that's two was euro, gold was three. Here's number four, Aussie dollar. DJ says, hey, Mike, 138.2 on the pitchfork on the Eurodollar weekly hits the highs of the February 2011 or 2018 rather, and current lows. Say that again on the weekly chart. Oh, the long-term pitchfork. Which one? This one. Well, the 138.2 is going to pull you out here. Oh, I'm so sorry. I'm looking at. Ah, interesting, 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 interesting. Interesting. Throw some sugar on that, DJ. I love it. So DJ is just picking out another long-term slope. So this is the pitchfork we've been following. No surprise. You guys have seen this before. This is 2015, 2013. Excuse me, 17 lows. The 138.2. So taking a Fibonacci reference of that slope seems to be offering some support here. The best way of knowing whether these are actually the efficacy, as it were, of these types of slope is to look at the inflection. On the inverse. So if we take the 38.2 of the top side of this slope where the breach happened in early 2018, looks like that zone caught resistance as well. Now, it just so happens we were looking at this parallel, which is the same slope extended off that swing high from late 2015. So, we were basically looking at the same zone anyway, but certainly helps, right? Certainly adds some flavor. I love it, DJ. We'll leave that on there. Yeah, I was like, what's the 38.2 here? You're looking a little too far out there. All right. Okay, so here's the deal with Aussie. I'm thrown off now. I'm not gonna lie to you. If it doesn't find support, basically like 20 pips from here, we're in trouble. That this thing is just gonna mark resumption. You guys all know the levels that we were talking about for a long time at 68.27, 68.54. We watched that pivot region as price came into it and posted a really sweet reversal in June. We saw the accelerated break and acceleration below once we cleared it on the downside in July. Like, what the hell is this now? Right? Um, don't like it. Weekly chart is starting to look a little bit dodgy here. Okay, so the only thing I would highlight here is, look, you're still looking at terminal resistance at like 69.27. That's the level that if we breach, you're looking for, it would validate that a low is registered last month. That's my opinion. Near-term support, well, you have the low close, which is right here. The low close came in right at 67.33. You have 67.45. That's the actual January stretch low. It's like last ditch effort. If it gets below that, you're basically looking for resumption. So there's not much to look at here on the Aussie weekly chart. Just keep your eye on this. The most constructive development would be for price to actually zero down and close the week above 68.27. If we're able to mount 68.27 on a weekly close basis, I would still like attacking the long side here. Okay, I would like still attacking the long side here. Here's Aussie on the daily chart. So here's why I say, like, if it finds support, it needs to be like basically around these levels. So 67.90 was the 50% retracement. You'll see it on the intraday chart. It's not that clean of a bounce off that level. If anything, I would just say, again, watch here the daily close for this daily chart. This pitchfork that we've been following, the median lines have been offering some resistance here. We've been waiting for this turn, if you guys recall, for the last 5 days. We were trying to see support hold in this zone. Once this broke, it really opens up 67.90, if not 67.66 to complete a 618 of the rally. And then the outside daily reversal close, the low day close for the month comes in at 67.45, or excuse me, 67.59 here. So a sweet spot, a little bit lower, right? Here's the intraday chart for Aussie. And here's what we look like heading into the release. Really nice bounce off of slope support, right? We noted that that was kind of like we needed to see this breach here to mark resumption, and that was 68.90, 68.79, basically 68.80. Well, the rebound popped. We tried to push through the weekly open, didn't work. We were still holding, okay, the weekly opening range heading into FOMC. Then we went around and broke lower. Once we cleared that 68.27, 68.32 region, you guys recall, there's 68.15. The accelerated break there fueled acceleration. And that took us into the 67.91 target, just lower. Here's the 618 at 67.66. So look, objective weekly opening range break lower. I would not try to, let me take a step back. We're heading into Thursday, right? You got that weekly opening range break. You look for a Thursday, Friday low in price. I'd need some pretty convicting price action to get us to try the long again. But yeah, essentially this thing would need to recover back above, like stabilize above 68.30 to get us back in. Remember, near-term uptrend break. We broke it, tested as resistance, and pushed off. I wouldn't expect this to be trend reversal. Remember, we're still working on the basic premise that this was a more significant low. So if it doesn't hold nearby support, if we don't hold 67.66, even 67.60, it's game over, right? This whole thing would be invalidated. This whole 6-day rally or whatever hell it gave us here would kind of be invalidated. So I'm looking for support in Aussie soon. Don't have anything on the table as far as risk is concerned, as far as exposure on this, not yet. There's nothing here that's been really, in my mind at least, justifying trying to jump in again. But we're looking for that exhaustion low in this region. Okay, into the end of the week, if we spike lower towards 67.66, great. If we close this week back above 68.30, I'm right back on board. Okay, but this washout definitely getting more intently, getting lower than we would have liked. So gonna lick my wounds on this one. Do want a little bit more of a conviction rebound, some sort of shift in price to get us back in on the longs. Remember, it's been quite a mighty stretch off the lows. We've now paired half of that rally, that rip, with the 618 just lower. I'm looking for an exhaustion low down here. It's just that there's no slope yet to get us excited about that. So Aussie goes on the shelf for a while until we get some definitive price action in the near term. Questions, comments, concerns on Aussie dollar? We can dump that 618 at this point. Bear with me just a moment. I want to see what this looks like. Huh. Well, ain't that interesting? Another confluence there at 67, 66, 67, 65. And then we don't know. There's no there's no validation to use this retracement, so don't go and run with this, guys. But just to show you how I'd be treating this, once we got some more reversal, maybe a trigger break in momentum, maybe a pop through 68, I don't know. That's when this retracement would start to come back into focus. And I guess for now, the only thing I would leave on here. Oof. You know, if we were to make a stronger rebound, maybe get back through that slope, the 618 of the recent decline gives you 68.45, and the weekly open 68.66. I would even dump this 38 too, to be honest with you. Boom. Those are the levels I'd be looking at on Aussie on the immediate front. On the immediate front. Okay, questions, comments, concerns on Aussie. Moving right along then. Dollar CAD flirting. She's a flirt. Here's dollar CAD, right? Um, Listen, ever since the start of the week, monthly R on Aussie dollar. Is that the resistance? Or is that pivot? Monthly R1? Because you have an exclamation point there. I'm assuming R1 is 68.48. Yes, monthly R1 says Puja is 68.48, you're saying. Oh, sweet. Throw some salt on that, or some sugar, I should say. Well, it depends what mood you're in. But yeah, listen, it's do or die here. I don't like just where we are in time. So if it jackknifes lower one more time, you have confluence Fibonacci sequence here with the 1618 off the high and the 618 off the low, giving you 67.55, 67.66. Yeah, that would be kind of the larger target on the way up. Let's see if we get it. Obviously, this won't be the 618 if we register a new low, so do keep that in mind. But a decent pivot in price, and if it's the R1 monthly, again, throw some more conviction on that. Here's dollar CAD. So look, ever since the start of the week, there was two levels we've been talking about, and it's been 32.84 and 33.06 of levels that you're trying to take or looking for exhaustion at. Um, you got a test and a failed stretch here. Yesterday, again, second target got taken out, 33.06, and you're trying to push it again, and that's failing again. It's still within downtrend support resistance. I don't know what everyone's getting super bullish about. It's still in the downslope. I mean, listen, it could break out, and if it clears 33, fine. But until it does, I don't really see the justification of trying to get cute here. Look, here's what dollar CAD looks like on the daily chart, just to put things in perspective. Okay, doesn't get much cleaner than this. Basic pitchfork off the near-term declines, the same one we're looking at in that intraday chart. Lower parallels caught 618 convergence on the lower parallel. Guess what? On the upper parallel, 618 convergence catching resistance. I mean, when you see this kind of symmetry, pay attention. It doesn't happen very often on the back of a 6-day advance. Look at that. Momentum failure right ahead of 60. Look at that. So all things held constant, I still like dollar CAD lower. Just my humble opinion. Excuse me. Again, on the weekly chart even, noting that we made that massive outside weekly reversal off resistance 2 weeks back, and we're essentially still sitting within the confines of that weekly range. Puts the focus on 31.55 as support, puts the focus on 33.70 as resistance. So on the longer term weekly chart, it's in the middle, slap in the middle of a massive range of significance, right? So until that clears, we're going to be nimble, but within the confines of that, you got this massive spike break of last month's opening range lows. Yeah, you got a rebound, but it was a nice confluence region to rebound off of. this is the first confluence region to rebound off of as resistance. So again, the weekly charts or the intraday charts, no change to any of those levels. Okay. Um, we simply tested this one again. 1618 extension at 3307 looks like it held an overnight trade. Here's the pullback. We need to see some things start to pick up here. Now watch slope as an initial level here. That gets you like 3230s. Weekly open support converges on this. You need to adjust this 50% retracement. It's going to converge right there as we put in the new high. So it's still basic same level, 3222, 3220. Okay, and it brings the 618 of the drop right into this nice pivot near the 32 handle. Anything, excuse me, if this thing pushes higher, anything, well, first of all, 3307 is still going to be bearish invalidation. That's still the same exact level. Nothing changes, that 1618. On intraday spikes, on today's session, if there's more juice on the downside right here, which I really hope there is, intra-session spikes should be held by 33 or 3290, basically this region. Okay, so if US market all of a sudden opens, this thing whipsaws higher or something, I'd want to see failure here. That'd be the ideal scenario to suggest that we really, in fact, have gotten inflection off the upper range. Now, for argument's sake, if we do make it through the highs, if we do make it through 33 and we push it through 3307, or we do break through up to the highs, there's nothing on tap to like 3355. We got a 50 pip run up to the 618. Not our favorite scenario, but that is the what if we break higher from here. Ideally, we hold 33, looking for a drop towards, that 3220 level. Any questions on dollar CAD? Dollar yen, I still haven't taken a trade on this one. It's been decent, I have to say. Remember that 108.41 was the region that we had highlighted right ahead of the release. Here's what dollar yen looked like ahead of FOMC. That 50% retracement actually never got clipped as of the FOMC or the day before the FOMC, which was 108.41. It converged on the median line. We talked about the gap. We talked about this on the open on Sunday. As the gap opened lower, we held right there. We actually gapped into the 107.47, 107.45 target that we were looking at as resistance on the way up. That held. To fill the gap necessitated a move to 108.05. We got that pretty early in the week. Okay. And then once we started to muddle higher, that median line started to offer some resistance. And then once we start to look ahead of heading into Fed, well, guess what? Now it converged on that parallel, on that 50. This is what happened. Now, if there's a lack of excitement in my voice, A, I'm probably getting sick, but B, it's because we still haven't even cleared the weekly opening range. And I'm going to sound redundant on these guys, but I looked for these things a lot to really help me give me conviction on my bias, that there's been an objective technical or basic price action signal telling us, okay, we should be looking lower or higher. I love where it turned. I hate that it's failing here again. I still like it lower below 108.41 near term. Ultimately, I do think this does break higher, but on the back of this advance, on the back of this rally, the whole point was it's looking pretty precarious here at the 50% retracement. Former slope. Remember, we were looking at this former slope support broke, was resistance early in the week. What the heck is that? I don't know if I'm going to keep that slope there anymore. But it certainly is not, what's the word I want to say? If price holds here, it could be a simple break of resistance, check as support, and then move off to the races. What I do know is that if it's going to break lower, These are the key regions that we should be looking for. First on this slope right here, which is basically what we're testing into the open today, 107.83, it's 2017 low day close. But the objective weekly opening range low, I hate to say it again, comes in at the former support again that we opened the week, still 107.45, 107.47. So I'm targeting 107.47. If we get the deeper thrust there, great. 106.78, 106.82. I think that would be a beautiful buy opportunity if we get it. But as it stands right now, you're checking former slope resistance. You're slap in the middle of the weekly opening range. Here's your weekly open. Here's your high. You're right in the middle. Fed couldn't give us enough for dollar yen. Even the abomination couldn't take cues yesterday. Okay. Before I completely lose my voice, we'll talk about SPX. Is Pete in the room? And if not, he'll probably see the recording here. Oh, man, what do I want to say about this? It's so ridiculous because there was someone, I'm not going to name names, on Daily Effects who had gotten into a uh, SPX options position. He was super excited. He was walking around. He's a young guy, really young guy, and he's just super happy that he caught a decent um, options move there. Our discussion before we left was probably not something you want to sit in because it's a Fed move. Man, he's underwater now, right? Because here's the rebound and recovery. Look, it broke channel support. And I know that we've been watching this one here in the room because we've been following this one for literally weeks within the confines of this near-term channel. And even heading into the Fed, I said, man, this thing is just, whoo, it is primed, right? Primed for the pump. Here's what SPX looked like right ahead of the release. Sitting on slope support, sitting on channel support, tested the weekly open at 3,005. And then here's what happened yesterday. Downside break, plummeted right back into what? 29.78, 29.81, the same zone that we were talking about as critical resistance on the way up here. We got faked out. It pulled back, pivoted through. We finally talked about this break being the accelerated rip. There was the next test of the record high day close. Pull back in that same zone, found support, and that was the weekly opening range lows. So all things held constant, guys. This thing simply made a test of the weekly range lows yesterday. It held. And here's what looks to be a pop of the weekly opening range highs. Now, I would note that this slope is still in play in my mind. You got 1, 2, 3 touches, break, resistance. We still need to clear this resistance, and then look what's here. 30.20, 30.26, record high day close, record highs. That's what still needs to be cleared. So I'm not saying we're talking about resumption per se, but boy, I mean, you should have lightened the load on a tag of or drop right into key support that we've been looking at, this major inflection range and the weekly opening range lows. And once that held into the close, I thought this was super precarious to continue favoring the short. And at the end of the day, and all basics would suggest easing softer monetary policy. Well, that's going to be good for the markets. There's no reason necessarily we should sell off. Now, yes, the forward guidance wasn't as dovish as the markets would want, as risk assets would want, but nothing's fundamentally changed. And every couple of days, you keep getting a nudge. Oh, the trade deal's going to happen. Oh, things are looking better, right? Look, I don't think the market's going to actually necessarily see a new high unless we get some sort of clarity or some sort of good news on that front. But at the same time, I mean, the Fed's just easing. Global central banks are easing. Don't know if it's necessarily a time to call the high in risk either. So that defensive, that pivot, that key region at 29.78, 29.82 has me really just focused on that still. Your world for SPX is 29.78 into 30.20, 30.26. That's all that matters right now. I would be willing to waddle into a couple of puts near 30.27, 30.40 if we see a weekly close below that. Um, yeah, it might be a little pricey, but yeah, Pooja, I wouldn't disagree with you too much. Why 30.40 though? Is you have slope there or something? I have 30s, 30 set, 30.20, 30.26 is sort of the key zone of resistance I'm looking for near term. It's probably a pivot there you're looking at, Pooja, right? All right. Well, if there are no other questions, or if you do have any other questions, guys, feel free to throw them on the message board at any time. I was looking at crude prices to see if we can come up with some sort of formation. I just don't. I I just want to bring this up first of all because someone was asking about it on the Tuesday webinar, and I was telling you guys not to touch it. And if anything, it was going to be a short because oh my goodness, Saudi Arabia got bombed. Crude going from 55 bucks to like 65 bucks wasn't going to happen. I mean, it wasn't justified in my book. And then again, we did materialize one daily close above the 60, 59, 70 threshold. But man, that lasted for what? Not even a day. Huge, massive pullback. So I wouldn't touch this per se just now, guys, but it's I have it still at risk near term below 60.45. Let's just say that. Pooja saying a pitchfork parallel on the SPX. Okay, fair enough. Fair enough. All right. Any other questions? Feel free to throw them out now. If not, guys, I do want to apologize for my little mishap this morning and last night. But hopefully we get things right back on track next week. Look, I do want to just say also, guys, that we're having serious talks with um, a whole bunch of parties, and we're looking to make our offering at SB much more effective and much more impactful, even more so than it is now. So look out for good things to come. I'll keep you guys updated as the news sort of materializes here. We're in deep negotiations with a lot of different venues, so I will keep you guys updated to that, but look forward to that. And other than that, best of luck trading. Take it easy and light into the weekend, guys, and have a great weekend. I will see you on the flip side Monday morning for the free session on Daily Effects, Tuesday, Thursday, right back here on SB Trade Desk, guys. Take care. Cheers.